In this video, we are going to talk about risk and reward for a standalone assets. Returns on investments, we can talk about this in the form of, suppose you purchase 10 shares of a stock for $1,000. The stock pays no dividends, but at the end of 1 year, you sell the stock for $1,100. What is the return? So obviously the return will be the sale price minus purchase price, and that gives you $100. And if you divide that by the amount that you invested, you can tell that the rate of return is 10%. On the other hand, if the stock sells for $900, then what would the return is going to be? You will still do the same calculation, sale price minus purchase price, and divided by the amount invested. So that's going to give us the return on investment. On the risk side, let's look at this example. Suppose an investor buys $100,000 worth of short-term treasury bills with an expected return of 5%. And then there's also an alternative. This same investor can invest $100,000 in the stock of a company just being organized to prospect for oil in mid-Atlantic with an expected rate of return of 20%. So in this case, which one is going to be better? In order to understand which one is going to be better, what we could do is we could look at the risk and return of these two situations and understand how the risk is changing. Usually the average investor is risk averse, and the higher a security's risk, the lower its price and the higher its required return. We have an example in here with two companies. One is Sale.com and the other one is Basic Foods. We have their probabilities for a strong, normal, and weak demand with their respective probabilities. And we also know the returns for each state, for each company. So given that, what we could do is, first of all, we can calculate the expected rate of return by multiplying each probability with their respective returns. So that would be 30% multiplied by the rate of return for the first company for a strong demand, plus for a normal demand, plus for a weak demand, and that's going to give us expected rate of return. If we do that for Sale.com, you can see that we come up with 15%, and then if we apply the same weighted average of outcomes to Basic Foods, we also have 15%. So in this example, their rate of return is exactly the same. Then what we can do is that we can look at their risk. The standalone risk is measured by the standard deviation. In order to calculate the standard deviation, what we do is we first compute the expected rate of return. Then we subtract the expected rate of return from each possible outcome. We square each deviation and then multiply the result by the probability of its related outcome, and then sum these products to obtain the variance. Finally, once we get the variance, the square root of the variance gives us the standard deviation. In this table, I have calculated all of those for you as explained, as summarized in the previous slide, and that gives us a standard deviation for sales.com as 58%. And we do the same thing for basic food, and then that gives us a standard deviation of 23%. In that, once we have that information, we know that each company has the same return. Now we can make our decision by looking at the risk, and we know that sales.com is a riskier investment than basic foods. So as a risk-averse investor, we would choose sales.com. I have another example here where I would like you to compute the expected return and the standard deviation. So the best thing is to work on this and then check the solution. I have provided the solution to you so you can check your math, make sure that you are computing it correctly. I'm going to skip this coefficient of variation for now, and I am going to actually go on to the next example, which is again, we have two companies, and in this case, we have four equally likely states of the economy for these two companies. And then in this example, I would like you to calculate expected return. And once you have the expected return, I would like you to calculate the standard deviation and the covariance calculations, so that you are getting familiar with those calculations. And then the covariance calculations are summarized in this slide in terms of how we compute covariance. The first step is always to get the expected rate of return and then calculate deviation from expected returns, which means subtracting the expected rate of return from each possible outcome, multiply to the two deviations, and then multiply the result by the probability of its related outcome. And then we can go back to that concept of correlation. Once we have the covariance, then correlation will be equal to covariance divided by the standard deviation of those two companies' assets. And then we can interpret the result by looking at the value that we compute. If correlation is greater than 0, then variables are positively correlated. If it's less than 0, they are negatively correlated. And if it's equal to 0, then these variables are not correlated. So this is pretty much the return, reward, and risk for two standalone assets. Next, we will look into the return and risk for portfolios. Talk to you soon.